Guys, if you've been watching this show, if you've been supporting it, if you've subscribed, if you've done a loan with me, if you're a real estate agent of mine, just want to say thank you so much for supporting me. If it weren't for this, I'd be stacking boxes or stocking shelves somewhere. I really don't have any other skills. This is all I've done since getting out of college, so I really don't want to do the alternatives. 7 years in, and I'm just very grateful. So thank you very much, first of all. But what I want to get on today is the 401ks. Can you take that money out to pay for your down payment and closing costs? The answer is yes. You can generally take money out of your 401k, but doing so may have some drawbacks. So we're going to go over the different types of ways you can take money out of your retirement account and any drawbacks to doing so. Also, I'm not giving you rules that are just blanket covered for every retirement account out there. So always confirm with your plan provider first and talk to an FA as well. Consult with them to see if they think this is a good idea for you, and even a CPA as well, because there's tax implications on this. 401ks are designed for you to be able to retire. So you really don't want to mess with that money if you really can't pay it back anytime soon. But if that's the next best option for you to bring money, then by all means do it. So number one, you can do what's called an early withdrawal. This is before you turn 59 and a half years old. Okay, so if you take money out before that age, that's 59 and a half, you can be subject to an early withdrawal penalty of 10% of the amount you take out. Additionally, it could be treated as taxable income at that point, which means you'll have to pay regular income taxes on it, and that could reduce the amount of money you receive. Second way to do it is a quick withdrawal. This is where if a plan lets you take out money and then put it back within 60 days. Now you got to check with your plan provider to see what's available to you, if they'll do this for you or not. Then there's a loan. Okay, so some of these 401ks, they allow you to take out loans, which would be then repaid with interest. Now the interest you pay back goes back into your 401k account, but there are still some drawbacks to consider here. Number one, taking a loan reduces the amount of money that can grow tax deferred in your retirement account. If you leave your job or are terminated, the outstanding balance might become due immediately. So if you can't repay this loan, it would be treated as an early withdrawal and subject to taxes and penalties. And the good thing about these loans is that we don't count them against you in your debt to income ratio. We don't say, hey, you have to add this monthly payment due from the 401k loan into your debt load to determine if you have enough income to cover all your minimum monthly payments with the new housing payment. And then there's number four thing you can do is a hardship withdrawal. So some cases of financial hardship, some plans may allow for penalty-free withdrawals, but taxes could still apply. These hardship withdrawals are generally limited to specific circumstances that would only be approved by your plan provider. Usually you gotta show some type of proof to them, like medical expenses, funeral expenses, avoiding foreclosure, eviction, tuition fees. But taking a hardship withdrawal could deplete your retirement savings and may make it more challenging to financially recover in the future. But that's the gist of taking money out of your 401k. It's an amazing way for you to get money if you don't have money easily available to you. And it's one of the most common ways of getting money outside of having savings. It probably is number two behind savings. Either getting a gift from family or taking money out of your 401k is definitely in second place there. So tell me if you learned anything, and I'll see you on the next one. Thank you.